Okay, let's take a look at what we have here. Manufacturer Southern leased high-tech equipment from, International Machines manufactures the equipment. So this is a sales lease. This is a direct sales. Okay. So, take a look. If that's the case, the $92,000 is both our cost of goods sold and our inventory. Okay, so we're going to need that. And we have the lease receivable, fair value of the asset, okay? Because they tell us that fair value of the asset is 134, so that's the amount of the receivable. And we have to figure out the interest rate. We're given 8%. I would double check, and if you do, you find out that it is indeed 8%, okay? So, let's do it at once. It wants us to take this information and do the journal entries. So, the lease receivable is the 134, 496 from above. That's also the total sales revenue, 134, 496. That's our total sale. Our cost of goods sold is the $92,000 it cost us to make it. And since we're selling it from our finished goods inventory, it's a reduction to our inventory of $92,000. The first journal entry says you got $18,000 cash, and it's at the beginning, so it's a reduction of the leased receivable. So the first 2/3 of this problem, we really just had to figure out what we were doing and just had to really read the problem. The only thing we have to figure out now is the last one, because we have some interest revenue, but we have $18,000 cash, and we know that's split between interest revenue and lease receivable. So we have to figure out how much we owe. So it's $134,496 was the original deal, $134,496. But that was reduced by the first $18,000 times 2%. Because that $18,000 reduced that directly. And let's take a look and do this. We have 134,496 minus 18,000 is 116,496 times 0.02. 23, 29.92, 23.30. So that's the interest revenue is 23.30. The difference between the 18,000 and the 23.30, 15,670 is the reduction to the lease receivable.